So if we look at silver, for example, in silver, I cannot analyze. There's not a company behind it where I can say the fundamentals are great. They have a projection of, I don't know, producing more products out there. I can look about like what's the demand, which industries need some silver, how's the supply, are there new mines opening up? As far as I understand, it's even a byproduct, silver, so you cannot just directly just mine it per se. So how do I look and understand now? Okay, I want to get out of my silver position. When is the right time? It looks like it still goes up, but what does the graph tell me? When can I exit? What are some signs or indicators?
Yeah, a couple points there. One of the things that I try really hard to do to educate people is if you don't own a silver position right now or a gold position, this is not the time to get in. I've heard stories of people lining up at pawn shops and silver dealers to buy. You're too late. Do not buy a silver or gold position right now. Like there's the risk reward is not in your favor. But if you do have an existing gold and silver position from a few years ago, it is time to start looking at harvesting those profits. And when we look back at the behavior of gold and silver over the last 50, 70 years, silver has had two similar massive spikes driven by geopolitical events. And both those times, the price spiked to $50 and was quickly basically slapped down, hammered down back to where it came from within a few months. So that's something to keep in mind that the silver goes through these cycles and it's a safe haven for geopolitical events. And now, in terms of applying technical analysis to the current price, there's something called Fibonacci that you can apply to this. It's one of these crazy things that if you've never seen it before, you're like, this doesn't make any sense. How can you use this to determine stock prices? But basically, Fibonacci is the golden ratio, 61. Uh, there's Fibonacci extensions like 1.6, 2.6, 3.6. And basically, right now, silver is sitting above one of its large Fibonacci extensions. And since it has blown past that extension, it looks like it wants to continue a little bit higher to its kind of final resting place in the Fibonacci scale. And that only happens when something like this, obviously, this is a super significant kind of Six Sigma event. This is an outlier. And only when we have outliers like this, the prices go to this very far end of the Fibonacci scale. I forget what the number is off the top of my head. I want to say it's 140, 150, something like that. Uh, but if you're like an amateur investor and you don't really know how this stuff works, one thing to keep in mind is that you're not always trying to time the exact top. If you bought silver at 20, $30 and it's now 120, like just go sell some. Go sell half, it's not always about timing the exact top because as we get up here in price, the risk of you getting destroyed on the way down becomes much higher than you being able to squeeze that last couple percent out of silver.
Got it. So looking at past events or past movements helps in technical analysis, right? So looking at the graph and see how it behaved in certain cycles of the industry, time of the year as well, depending on the asset, because some stocks are more cyclical. So that helps. You have to really go into the past as well and look where has it been.
Yep. And so it's, things can always change, but um, these patterns repeat themselves. And certain stock prices have really clean charts where I was looking at a therapeutics company yesterday, a biotech company, and three times over the last 20 years, the price has gone from $10 to $180 to $10 to $180, and it's currently sitting at $20. So if we kind of apply that cyclical approach, that's a good time to get in the stock. What we're trying to avoid is people experiencing that hype, when the stock is at $180, that stock might be in the news. People are talking about, hey, I made, 9x my money on the stock and you should buy it too. Well, if you bought it at 180 and it went to 10, you just lost 95% of your money. There are these cycles out there that exist in every industry. it factors in geopolitics, it factors in earnings, all that kind of stuff. These cycles repeat over and over again.